Okay, guys, it's official. We are officially live on Facebook. Welcome, Facebook. First of all, Stephanie, last time we were here, we were under the impression, or we knew, but our audience didn't know that we'd be coming back on Wednesday.
Right. They thought we were taking a break. However, we are back and we are back with Wisdom Wednesday. So, in light of our break from our Super Series Tuesday, we are very excited to be joined by our partners, Prime Lending, for Wisdom Wednesdays.
You know, the good thing about Wisdom Wednesday, and the one thing that I love about Wisdom Wednesday and how it came right after the conclusion of Super Series Tuesday, is during Super Series we kind of told everybody what they need to do, you need to buy a house, then buy the car, buy a house, then get the additional liabilities. But Wisdom Wednesday is designed to give the consumer the how to as it relates to home ownership. So that's why I'm so excited today to announce the launch of 6 episodes of Wisdom Wednesday. And today we are starting with credit from a lender's perspective, because what we know is lenders view your mid score, your approval score, differently than anyone else does. And we're going to hear directly from the lender. Stephanie?
Absolutely. So today we have our special guest with us, and her name is Joyce Bauman. So let me tell you a little bit about Joyce.
Oh,
Joyce,
wait. Stephanie, wait. Guess what we forgot? We made an assumption that they know who we are.
well, you know what? I just thought that because we've been on so long that our viewers know who we are. They know us, they love us, they always tune it in. So let me just say,
Yeah.
I am Stephanie Milburn. I'm the campaign manager of House in the Car.
And my name is Letitia Grant. I am the chair of House in the Car. And we are here with Wisdom Wednesday creator, Miss Latanya Donaldson. Latanya, tell us a little bit. Look, I like to get in the mind of the creator. Tell us a little bit about Wisdom Wednesday with Prime Lending.
Well, hello, ladies. It is always such a pleasure, pardon me, joining you guys. I'm Latanya Donaldson, Director of Multicultural Lending for Prime Lending. So, Letitia, let me tell you how that came about. I mean, and you really kind of just spoke about it. You know, we've been talking about buying a house. And so, you know, as I told you, I've been hanging around you a lot now. And I said, okay, we'll go to Wednesday, but we need to name Wednesday. And wisdom just popped in my mind. So that's how it happened. So I have to give you some of the credit on this, because I mean, you're training me very well to come up with these, you know, these catchy phrases, if you will. But no, to your point, it is all about the wisdom. I love your build up to that. You're absolutely right. We talked about buying a house, but now we get to the how. And to your point, it's the fun part, right? You know, so we're here for the next 6 series to talk all about wisdom. Wednesday. Try saying that 30 times.
Well, we could not speak about wisdom without having someone who is very knowledgeable and that has been in the business for such a long time. So without further ado, let me introduce our special guest today, Ms. Joyce Bauman. And she began her illustrious career as a mortgage professional in October 1978, guys. So when we talk about wisdom, this is what we're talking about. She has been in business for a very long time. So she was a successful producing branch manager for National City Mortgage for 25 years and has been a senior loan officer with Prime Lending in Moraine, Ohio for the past 7 years. With over 42 years of mortgage experience to her credit, it is abundantly clear that Joyce is fully committed to delivering the dream of home ownership. As a trusted advisor and well-respected industry professional, Joyce selflessly shares her wealth of business acumen and proven leadership expertise with all of her clients. Her legacy of service and years of training establishes her as a subject matter expert in most loans type, including conventional, FHA, and VA. Her passion lies in educating prospective first-time homebuyers on the mortgage process to ensure clarity and to promote sustainable wealth for future transactions. So guys, please give a warm virtual welcome to our special guest host and speaker, Joyce Ballman.
Thank you.
Well, welcome, Joy.
Thank you.
Welcome, welcome. Thank you so much for joining us. We really appreciate it. And you know, to kick it off with saying Wisdom Wednesday, and we were kind of talking before we started the show about the amount of knowledge that you have in this particular area as it relates to credit scores and to lending. Do you want to say anything to our audience before we dive right in?
Well, the most important, well, of course, income is the most important part of the whole transaction for qualifying for the loan. But just equally as important is credit. So this is an important topic and very important to understand as well.
Good deal. Well, for those of you that don't know, this series is called The Lender Connection. And we're starting off the episode with credit from a lender's perspective. What's your score? Now, Joyce, I'm just going to dive right into it. Let's discuss the elephant in the room, because we've all heard it. We hear our clients come to us and say, oh, I hear that you can purchase a home with a 580 credit score. I hear it all the time. Is that a fact, Joyce?
Right now during COVID, you'll find less and less lenders that will go as low as a 580 credit score. However, they are out there. With a 580 credit score, you might have some additional hoops to jump through in terms of having additional cash after closing, etc. There are still some lenders out there. Many lenders have just temporarily increased the minimum credit score to 620, and in some other cases 640, and in some other cases 660. However, the day will come, I'm sure, as we get this pandemic under control, that more lenders will go back to that 580 credit score as their bottom threshold again.
Gotcha. So 580 is a fact. You did say additional hoops. And I don't know. I don't like doing circus tricks. Do you, Stephanie?
No, I don't. And I try to advise my clients to get their credit score at least to a 620 or a 640.
Yeah. Because it kind of eliminates
and I think
the
that is very wise.
Good deal. Thank you, Joyce. It kind of eliminates the opportunity to take advantage of down payment assistance. So we like to keep that option open. Now, you said additional hoops, but if I'm not mistaken, we'll hear a term called overlays. So what is an overlay?
Well, each lender has guidelines that they follow based on the investor. FHA, VA, conventional, etc., have their own, and as you mentioned, first-time homebuyer loans, they have their own guidelines. Lenders, maybe because of past experience, might add something on top of what the investor guidelines are, such as if you have a credit score that's 620 or lower, we might need 320 or need assets in reserves. So an overlay is put on by the bank. It doesn't necessarily have anything to do with the rules of that particular program, but all lenders have some overlays.
Yeah. And how does it affect the potential homeowner?
Well, that's where sometimes maybe you need to shop for a lender because some lenders might not have such strict overlays. At Prime Lending, we try to keep our overlays at a minimum. So in other words, an overlay usually makes it a little bit more difficult to get the transaction.
Yeah. when you started, when you opened up and started speaking, you mentioned income and you mentioned credit. I have found that some of the overlays reduce the buyer's debt to income ratio, which ultimately
Yes.
means that they can't qualify for as much home as they were seeking.
That is correct. For example, if you're in a credit score range of say 620 to 640 on some loan programs, they may say that it is a requirement that your debt to income ratio be lower than what they might allow for someone who has really, really high credit scores. In other words, they feel the higher the credit score, the more ability to manage your debt, and therefore put you in a position where you might be able to qualify at a higher debt to income ratio.
Gotcha. And we've talked a lot about credit score. We've talked a lot about credit, but what is the scoring model used by the lending institutions?
Well, there's a certain model that is set up that's kind of, I would say, is a secret. Somewhere along the lines, the mortgage groups got together and said, these are our hot spots, and we want our scoring model to match those hot spots. With a mortgage loan, you have 3 credit repositories pulled in. It's called a tri-merge credit report. When you go and buy a car, they may go out there and they might just pull TransUnion, or they might just pull Equifax. When you go out and get a credit card, again, it might just be one credit repository. A tri-merged credit report that is used for a mortgage loan pulls in TransUnion, Equifax, and Experian, and it's the middle of the 3 scores that determines what is being used to price that loan and qualify that loan, et cetera. I want to interject really quick. Oh, am I getting feedback here? But I want to interject because you mentioned Letitia and Stephanie up front. Well, Stephanie, you said, I always try to tell my customers they need a minimum of 620 to 630, which I applaud you for that. But so Joyce brings up something that's really important. So when we say, okay, you need to have your credit score at 620 or 630, I think it's important to know that has to be our credit score, which Joyce just mentioned. It has to, that's what we have to pull. So, Joyce, can you talk a little bit about the difference, where I'm going with this, the difference and what the customer has access to in terms of pulling credit and what we actually pull? Because that's, how many times have we heard it? I know Letitia, Stephanie, you guys can chime in. The customer pulls the credit and they use some, an internet outfit, and they might, well, it said I had a 680, and then they get to the mortgage company and it's like, oh,
580.
right, exactly.
Somebody got good credit.
Yes, and here's the situation. There is a different modeling for installment loans. There's a different modeling for consumer reports. There's a different modeling for credit cards. And of course, there is a different modeling for mortgage. So unfortunately, when the consumer goes out there, they might be getting an update on their credit scores from their Discover card bill. Remember, that's a credit card. They're not using the same model as the mortgage company is using for the mortgage report. So the best thing to tell them is, it sounds like your credit score is good, but you are going to need to talk to a mortgage professional, start the pre-approval process so that you know what your credit score is. And if the credit score is something that cannot work for the loan program you're looking for, that lender can either put you in touch with a credit repair company or give you some ideas of what they think might improve your credit scores. Remember though, loan officers are not credit counselors. So really the professionals should be giving them the advice as to whether they need to pay down a credit card, whether they need to open another credit card and use it sparingly for a certain period of time. So that's why there's so much confusion about credit scores, because the consumer is going out there and pulling something that has nothing to do with mortgage.
You know, Stephanie, I have one thing. I'm going to call you and I to the carpet. There is one thing that we fail to do for our audience. We fail to let them know that they're going to need pen and paper or a note-taking device for today. Joyce is just giving a lot of information, and all of it is noteworthy. So,
you know what? I think our audience is well aware, because all of the information that we have given in our Super Series Tuesday sessions, they know that they need to come equipped with that pen and paper. I think they're ready.
Okay. Look, I was going to take a second and pause for the cause and let them go grab some paper and a pencil, but I'll keep going. If I trust you, if you say they got it, they got it.
They're ready. Hey, audience, I know y'all.
Okay. Joyce, can you tell us, how does a lender view collections and or charge-offs?
Well, it's different based on the loan product. Charge-offs are generally, most of us rely on our automated underwriting system to tell us how to handle a specific charge-off. And it will say, sometimes we'll get a feedback that will say, if you have any charge-off or any collection higher than $250, or the combination of the collections are above $2,000, this is what FHA feedback will say, that they must be paid off prior to closing, or you need to assign a 5% payment to the balance on each collection account and get them qualified with that. So it's really the feedback of the lender. Collections have become, depending upon what it does to your credit score, now keep that in mind, but collections have become less of a concern due to medical. A lot of medical collections can be just disregarded. But the long and the short of it is, first we're going to get some sort of a feedback because of the credit score, but then secondly, we're going to get feedback from our automated underwriting system to tell us how we need to handle that collection or charge off.
Yeah.
And one thing I wanted to add about collections, Joyce, correct me if I'm wrong. I think the important thing to understand about collections or charge off, by the time that we see that credit report as a lender, it has already done the damage to your score. Right. The damage has already been done. Where you have an opportunity to really raise that credit score is in your behavior of how you're paying your bills on a monthly basis. And I'm not going to take Joyce's thunder, but the reduction of debt, that's huge. Right. Correct.
Now, Joyce, you said automated underwriting, which we call AU sometimes. You will hear that term thrown around, AU. But we all know that there's also an underwriter. So can you talk to the audience about the process and how many times they're underwritten and what one means versus what the other one means?
Oh, absolutely. I would say, I'm speaking from the experiences to all the places that I have worked for. Well, I say all, there haven't been many. But most of the institutions where I've worked in the last probably 10 to 15 years heavily rely on the loan officer to input all the information, pull the credit in, check the income, check the assets, and take a full loan application and then run it through a system that's supposed to pick up on things. Let's say I have a credit report And for some reason, I didn't see, I had decent credit scores and I thought, oh, this loan looks just perfect, great credit scores. And then all of a sudden, the automated underwriting system picks up, well, this individual had a bankruptcy and it's less than blah, blah, blah old. So the automated underwriting system has intelligence to a point to know whether the loan fits the loan criteria or not. But the underwriter checks the validity of the information that's been put in by the loan officer to validate, yes, it matches the findings and therefore we've got an approvable loan. And then that's when the overlays might be attacked, if there are, for that product. So you might run something. Oh, I'm sorry.
Oh, no, that's okay. I was going to say, so that would be the reason why the file would come out. For an example, an individual applies for a loan today and they're asked to bring 5 documents. It goes to underwriting and then the underwriter asks for an additional 10 documents.
Right.
Okay.
It shouldn't be that way. If a loan officer knows what they're doing, generally, it'll come out of underwriting with less conditions. But then sometimes you'll see things that would be unforeseen that are picked up by a fraud alert or something like that. Because all of us lenders have to run our loans, and it happens more in the processing and underwriting part of the transaction where a fraud guard is run. And there might be something that says, oh, we see that somebody with a similar name and social security number owns a property in such and such Michigan. Is that true? Or whatever. So generally, if a loan officer's done what they're supposed to do up front, there's not too many additional things that are asked for by the underwriter.
Okay. There's one more thing that we briefly talked about earlier, and we didn't quite define it. And that's debt to income ratio. And we talked about the effects of having collections on your credit report and that can count as debt. But let's talk about debt to income ratio with our audience.
Well, debt to income ratio, there are guidelines. Back when I started in the business, they were drop dead guidelines, or they weren't guidelines, they were rules, because we didn't have an automated underwriting system that could look at all the attributes of the customer and say this one might qualify for a little bit higher debt to income ratio than the other. VA has their ratio, and it's just one ratio, and that's 41%. However, I've seen VA loans be approved above 50, but that's because they add into it residual income and how close you are to a base and so on and so forth. FHA's guidelines were always 41 and 43, 41 being the housing and 43 the maximum. That is stretched all the time. But there's extra hoops you jump into over a 50% debt to income ratio on an FHA, even if you get an approval. Conventional used to always be 28 and 36. We see some conventional loans, depending upon down payment, depending upon credit score, depending upon a lot of things, that can go up to 50. So the ratios are just a guideline at this point. The automated underwriting system tells us how far we can go.
Gotcha. Well, Joyce, so I'm going to give you a scenario. My good friend, Stephanie Milburn, is in the market to purchase a home. She has champagne taste on a beer budget.
Like most of us.
Her credit score is at a place where she can get an approval. But I'd like for you to walk our audience through that complete process? Like, when should they call you? And at what point are you going to provide my dear friend with that reality check? Because she's expecting to live next door to Beyonce and Jay-Z. And I just want her to know
Me too.
I just want her to know that that's not a possibility. But when does she find that out? Let's walk her through the entire loan approval process. We've already told her house first, then the car. Like right now, she's driving around in her 1974 Pinto.
I'm losing you.
Oh, am I back?
Yes.
Okay,
Yes.
so I said right now she's driving around in her 1974 Pinto because she's waiting to buy that house next door to Jay-Z and Beyonce.
I wasn't even born in 1974.
Uh-huh.
But okay.
So go ahead, Joyce, walk us through it.
So, so basically, of course, I've told realtors, for years and years and years, don't put anybody in your car until you have a pre-approval letter. And the reason I say that is because I'll get a phone call at 8 p.m. on Saturday night saying, I have somebody that wants to put an offer in on a house and I need a pre-approval letter. That's a little bit difficult, but we can jump through hoops. But so basically what a loan officer would do would be to ask the customer to either go online and apply online or sit on the phone with them and fill out a complete loan application. Then I send them an email and say, gosh, you're self-employed. So I'm going to need your 2019 and 2018 federal tax returns, all pages. I'm going to need your most recent 2 months of bank statements, all pages. And, any number of things that based on my conversation with them, that I feel that I need to look at. And of course, I pull the credit and ask questions about that, et cetera. So once I've taken the loan application, pulled the credit, and received the documents back, it's usually probably, and it depends on lender to lender. If it's an easy, everything matches up perfectly, you can usually do that pre-approval letter within a fairly short period of time. But if it's complicated, you may have to go further. You may have to talk to an underwriter. You may have to, because the pre-approval is the opinion of the loan officer with documentation. An actual approval comes once you found a property, because then you have to get the appraisal and put the taxes in and so on. So underwriters, unless you have a tough case, underwriters generally do not look at a borrower until they have a property.
Gotcha.
And I think that's pretty much across the board. And that's really called a pre-qualification.
Yeah. Now you also said all pages. So my friend Stephanie is also very stubborn. I'll ask her to send me all pages, including the one that says this page is intentionally left blank.
It was blank. Why do you need it?
That because it's listed on the front page of the bank statement that there are 1 of 4, and if it says 1 of 4, even if it's intentionally blank, we need all 4 pages because we don't know it's blank. What if it has additional information like, oh, this person has multiple overdrafts, they keep on writing bad checks, it could have anything on it. So if it says 1 of 4 on the front of the bank statement, we need all 4 pages.
Yeah. Okay. You heard that, Stephanie?
I guess.
And Joyce, because of course we spent a little bit of time kind of addressing the process, because I think that's important, especially if we're going to tell someone how to do it. But if we're going to have a solid file, the file that gives everyone limited stress, because purchasing a home is just stressful, period. What credit
Sure.
score should we strive for?
I think you'll find that almost every loan product is available to you with minimal down at 680 or greater. Now, let me explain that a little bit further. Now, COVID has caused the underwriting, the automated underwriting systems have been tightened up a little bit because of COVID, because you don't want a on the line borrower that might be in a situation where they have loss of income at some point, go into a new home purchase. But for example, on a conventional loan, they say you can get down to a 620 credit score and still get an automated underwriting approval most of the time. Well, not most of the time, only some of the time. Here's when I've seen it. Let's say somebody has a 620 credit score, but they have a spouse that's on the loan, or just another co-borrower that's on the loan that has a 740. And let's say their ratios are in line and they're putting a decent amount of money down. You might, and of course, the lower of the two scores is the one that drives the pricing and loan approval on any file. So if you have a really, really strong borrower, unfortunately, we're going to price the loan to the middle score of the lowest, and let's say it's 620. So most of the time, a 620 credit score on a conventional is not going to get approved by an automated underwriting system. And then, of course, that's a block, that's a stop, that's done. But if you have another borrower that's strong, you still might get that one through. So if you're talking about 680, you can do the 3% down programs almost every day of the week if you're at a 680 or higher, but it does not mean you have to be at 680 to get approved on a conventional. A stress-free loan is probably anything 680 or above, to where, you know, you have a little bit more flexibility, I guess.
Yeah, and just to make the clarification, you don't have to have a 680. The question was, what would be basically just as we would say as loan officers, what's going to fly through the system? And you know, one term that came to me, Joyce, is compensating factors. Because that's what we're talking about, is compensating factors. You know, Joyce, you mentioned it, you know, the person who has the 620 mid score, but then the co-borrower has somewhere in the sevens. See, now we're talking about compensating factors. I remember when I originated, I'll never forget, when I was young in the business, someone came to me and they gave me this really cute analogy that I still remember. You know, underwriting is like this, it's the scale, right? So now this person has, you know, they have 6 months of reserves. We just went up on this side. Okay, now we have, this person's been on their job for 20 years, you know. So it's trying to find that balance, because at the end of the day, we want to make sure that we're giving the customer a loan where they can be financially successful in the transaction.
Exactly. And cash reserves can be a huge compensating factor, but can't be used in lieu of good credit.
So cash reserves, would that include a 401k?
Yes. Now, during COVID, they're a little bit pickier on the 401ks because of fluctuating income on some loan programs. We had finally gotten to the point where if somebody had a 401k and you could prove that they could borrow against it and you knew what the balance was, or that they could do they could do a withdrawal on that 401k, we didn't even have to see liquidation.
Okay.
Right now with COVID, we have to see liquidation to assume they're using those funds for down payment or closing costs. So that makes it a little bit more difficult.
Now, Joyce, here in our office, we also do property management. And sometimes we have to file eviction. We have to evict the tenant. And that shows up on their credit report as a judgment. How do judgments and bankruptcy affect one's one credit score and two approval?
Well, they definitely negatively affect the credit scores, but to what extent is pretty difficult. Now, speaking about judgments, I would say across the board, a judgment has to be satisfied to get a loan. Now, I think there's some cases from time to time, but I just really can't think of anything because usually judgments have to be satisfied. Bankruptcies vary between investors for types of loans. I shouldn't say investors, types of loans. Bankruptcies are different for VA and FHA and for conventional. With a FHA loan, if you have been discharged from your bankruptcy for 2 years, you can get a new mortgage. Conventional bankruptcy is 3 or 4. This is terrible. All the 3, I believe, or 4. Gosh, I'm sorry. I'm drawing a blank for some reason. But foreclosures, 7 years on conventional, 4 years on FHA. So all of that varies between the type of loan program.
Gotcha. Well, guys, you
And it
heard
will
it
affect
here.
your credit scores, of course.
You heard it here. Joyce said, pay all of your judgments. And I wish home ownership on all of our delinquent tenants.
Yes,
So that we know we'll get paid. No,
Exactly.
just joking. Well, I mean, just joking and seriously, right? Because you won't be able to obtain a loan for a mortgage if you're delinquent or have a judgment on your credit report from not paying your rental. And it just shows that you have the ability to pay. Yeah.
Well, it just proves their attitude towards their housing obligation.
Yeah.
And we want to make loans to people that are going to pay us back. So, a lot of people say, well, you can just foreclose on the house and sell it if we don't pay it. We don't want to foreclose on properties. You never win. You never win on a foreclosure. Your costs to foreclose on that borrower are far greater than what you usually recoup when you sell the property.
Yeah.
So I've always told people, the sad thing is they teach us all these things in school that we'll never use, but there are very few educational programs that are taught in the schools that talk about the importance of maintaining good credit history. And we all learn it pretty much from our parents. Well, some really good people don't have really good parents, and you hope that they're not trained incorrectly by their family values and parents' values. I had a wonderful customer, fabulous income, very well educated, that I couldn't make a loan to because they had so much debt. Plus, they also had delinquent debt. And, basically they said to me, I can't believe that with my educational level and with my income that you can't possibly get me a loan. Well, I couldn't. And unfortunately, that was probably one of the parents of one of the two individuals apparently didn't have a good relationship with credit either. So.
And that's a good thing to bring up, Joyce, because, you know, that is exactly why we're here today. It's all about education and financial literacy. And I will tell the, you know, the audience, one of the things that Prime Lending, what we're doing now, we're partnering with people or, you know, with different organizations like House in the Car, because it is about educating. And you're absolutely right.
Right.
I've been an advocate for that for a minute now. I think that there has to be curriculum, you know, in our universities, in school, that starts to talk about financial responsibility at an early age, because you do bring up a good point. Depending on the environment that you are raised in, and these are good people, but see, you know, it's kind of generational, right? If they didn't receive any education on financial literacy, then what are the chances for you know, as the kids grow up, they're probably not going to have a huge opportunity at financial literacy.
Right.
And it needs to start in high school, because how many kids don't go on to school, don't go on to college, and they might go on to trade school. Well, they're not going to get this education in trade school. So it starts in high school. And it can't be just a class for a 12-week period. I think it should be a 12-week class every year that a child is in high school.
Yeah.
We expect some of our education of our children, our society, our children, to be done by the parents. Not all parents are equipped to give them good advice on that, because maybe they were not given good advice. So
Absolutely.
You know, I'm always reminded of the story with my grandmother. She's an amazing person. My grandmother is amazing. She'll feed anybody. She just goes out her way for everyone. But if it wasn't for my grandfather, credit, finances, we would not have it. So my grandmother would say, oh, well, yeah, that bill's due, but it didn't come in the mail, so I don't have to pay it. And we're like, no, just because they failed to send it to you, you use the goods, you have to pay it. But, you know, and that just goes to show, to your point that you talked about, you know, we know some great people, amazing people with poor credit. Now, luckily for her, you know, she married someone that was very conscious about credit and all of that. It's like this whole old school situation. You know, she was married very young, didn't work. He worked, he paid all the bills, and she just took care of the kids. Well, that happened to work for them. Now, I'm still waiting. I'm not taking care of the kids. But I'm always reminded of that story, because, you know, and when you said great people, and for her, it was just, well, they didn't send it, so they don't want their money.
Yeah. And it's, unfortunately, it's lost in the mail. I've had people say, well, I opened up a credit card, and we're like, you didn't even make the first payment on the credit card. Well, I never got a bill. Okay, do you remember opening that credit card?
Right,
Putting
right.
money on it. Yeah, for some reason, people think that if they don't get the bill, it leaves them not responsible for the payment. But of course, we all know that's not true.
So Joyce, I thought this is a great segue. You mentioned high school, Letitia, you mentioned college. Can you just spend a couple of a minute on student loans?
Yes, for sure. Student loans, I believe, are the only, or at least federal student loans, maybe all student loans, are the only thing that you cannot receive debt relief from with a bankruptcy. So very serious. Student loans are very, very serious. Now, what happens is, again, each type of loan product, FHA, VA, conventional, have their own rules on how you handle student loan debt when they are in forbearance, they're not due yet, or they're in deferment, they're not due yet. Used to be years ago that if a student loan was in deferment, you didn't count count any payment against the borrower. Then they started to realize that people are racking up huge amounts of student loans, that if they don't start paying at some point, they're going to have to start paying. And what's that going to do to their ability to make their house payment? So each has their own rules on that. Generally, you would go by what the monthly payment is reporting on the credit report, unless it is zero. If it's zero, then you have to go with a rule of thumb, like FHA says, 5% of the balance. So if it's 100,000, then that's a $5,000 a month debt if there's no payment reported on the credit report. So student loan debt is definitely pretty high priority in terms of keeping straight. The other problem is a lot of people have very low credit scores, not because they haven't paid their student loan debt, but because it would come out of deferment and they wouldn't file the paperwork to defer it further. In other words, let's say they had a student loan debt that came out of deferment, but they were still in school, so they were still within their grace period of not paying, and they forgot to put it back in deferment, then it's going to start racking up late payments, okay? The month after it came out, then the next month after it came out, and so on and so forth. That can really damage someone's credit. So, very important debt.
So,
I'm losing you again.
Stephanie, and that's, am I back?
You are
Kind of,
kind of, sort of.
Well, I was just saying that with house in the car, that's a part of the conversation, the student loan debt. You know, we have a lot of individuals with very high student loan debt. We need to look at that holistically before applying for the student loans. If you don't need it, don't get it. The older generation used to say things like, if you can't pay it, don't obtain it, you know, different things like that. So it's a good conversation, you know, to have.
Absolutely.
Stephanie, do we have any questions, comments from our Facebook audience?
Yes, we do. We do have some questions and comments. Jean says that Joyce is an industry icon.
Oh.
And Aquarius Love wants to know, how do you find out which overlays a lender leans to?
Well, unfortunately, that's kind of a hit or miss thing that they'll find when they contact that particular lender, because it's not something that's published. And most people wouldn't understand what the overlay means anyway. So it's really kind of hit or miss. And a lot of people are directed either by friends or family to a lender, or a real estate agent will direct them to a certain lender. And they really ought to listen to people who have experience, because if they don't, then they're going to end up in a situation where they might end up with a lender that has a lot of overlays, or a loan officer that really doesn't have any knowledge. So a lot of people shop by rate. Never shop by rate. You should shop by reputation.
Great point.
Yes, that is a good point. That is a good point, because I had a client, they were getting a very low rate from a company I had never heard of. And then when they asked me about it, I couldn't answer any questions for them. I was like, I don't know. So you might want to do a little bit more research on this particular company, but ultimately they end up going with someone that I've worked with for many years. So definitely that reputation is important.
Very much.
Yeah. So, and actually in the comments, Janine Hunter answered the question for Aquarius also, she said some of the same things. Let's see, and they're talking about the bankruptcy discharge date. So Janine is answering questions in the comment section for us, guys. So thank you. And who else? Coretta said, great point taken. I have mine. She's referring to her pen and paper and her notepad. She was ready. She was ready.
She was ready.
She was ready. Veronica says hello. And I believe that is all of our questions right now.
Well, I'll say, Stephanie, I did see our parents log on and give us a love. So, you know, that goes so far. I'm going to shout out to my mom, Loretta Templeton, and Stephanie's mom, Miss Carolyn Lewis. They're always on. You know, there's not a show that we're on that they're not watching.
And today we even have Auntie Bernice on.
They keep us straight. We have to walk the straight and narrow when we know that they're watching.
Yeah.
Well, LaTonya, I guess, you know, we'll hand it over to you. This is your brainchild, your baby. We're going to hand the closeout over to you.
All right. Well, listen, thank you guys so much. Hopefully our audience got some very valuable nuggets to take away. And, you know, some of the points that I wrote down, you know, the one being, make sure you're with a professional. Joyce Ballman, as we started out earlier, she is a veteran in this business. So if you guys have any questions, please reach out to Prime Lending. You can email me at ldonaldson@primelending.com. Joyce, I will allow you to give out your email address.
My email address is the letter J, and then it's Ballman, B as in boy, ALLMANN @primelending.com.
Thank you very much. And now I'm real excited, Letitia and Stephanie, because next week, we need to know where the money is. So we're going to talk about where the money is. We're going to talk about a written budget and how that is your roadmap to success. Today, we talked about the lender and, you know, some of the first steps in the pre-approval process from a credit perspective. Next week, we're going to talk about budget. As Letitia mentioned, as when we first came on, we're going to start building. We talked about the importance of buying a home, but now we're going to show you how. And I think the most important thing, you want to make sure that you're working with someone who is incredibly vested into your financial success, which now you're starting to, this is called wealth creation, right? So again, Joyce Ballman, thank you so much for coming on. We really appreciate the information. Stephanie and Letitia, you guys, if you're in the Houston area, they're in the Houston area. They're some of the best realtors on this side of the border, right? And then Joyce hails from the great state of Ohio. She services the Dayton, Ohio area, but we're just not only in Ohio. We're basically all across America. So please reach out to us. We will be more than happy to make your dream of home ownership a reality.
Hey guys, really quickly, we did have one other question, and Joyce, I'll let you answer it. It's what about new development? Example, someone that's 55 and older, are there any assistance programs for first-time buyers at that age?
Well, a first-time home buyer really doesn't have age associated with it. Now, each state or each city or each county may have some of their own criteria for first-time homebuyer programs. I'm not aware of any that just specifically help out the 55 and older, but any first-time homebuyer at any age would have some benefits, such as reduced down payment assistance, etc.
And let me just, there is no type of, there is no age requirement or anything to do with age. So to Joyce's point, there are some first-time home buyer programs out there. Again, come talk to Prime Lending. We'll be more than happy to tell you all about it. But to Joyce's point, depending on what area you're in, you know, you have a lot of DPA programs, which would be down payment assistance. That's going to be specific to your area. That was a great question.
You know, and Latanya, what I wanted to also add, you said that you are in many different states. I will say we know that Prime Lending has been our trusted source here in Houston for some time. And we're actually going to have John Christoph on at 5 p.m., Stephanie and I with Task Realty Group. And we're going to be talking renovation products and not just that 203K. So the wealth of knowledge that is held within Prime Lending, it just continues to go. It's just well beyond what you would assume one company can provide to you. So those of you that have not located your Prime Lending office in your area, I urge you to do so. I don't know a product that they can't do.
Well, I will tell you, I think we are the experts across the country in renovation loans, both conventional home style and 203K FHA.
Absolutely.
Well, we're going to have some fun at 5 o'clock.
All right. Well, guys, thank you again so much for joining us. It has been phenomenal. We will be back, Letitia, when? Next Wednesday? Wednesday.
Next Wednesday.
That's right. All right. Well, you guys
Get ready for more wisdom. And
That's
I know my audience is already going to be ready
are
with their
going
pen
to
and
bring
paper.
on the wisdom. All right, guys. Thank you for now. Bye.
Thank
Thank
you.
you. Bye-bye.
Bye-bye.